Hey Mike, recently I was asked what are the most common questions you get about investing? And I've always find it relates to concerns about asset allocation and market timing.
You know, Jeff, the most common trait of successful investors is disciplined behavior. As the market starts to exhibit volatility, successful investors are able to maintain their focus, stay on their plans, and ultimately they achieve better long-term results. Unfortunately, without discipline, the average investor finds themselves very influenced by the 24-hour news cycle. As a result of this, they get feelings of uncertainty and doubt and ultimately make really bad decisions. Examples of this would be selling assets once the market has already declined and then trying to re-enter the market after it's already recovered. In fact, studies have shown that the average investor dramatically underperforms the broader market based on this lack of discipline. And this is because they try and time the market or chase returns. Now, Jeff, can you walk us through a strategy that would help undisciplined investors?
Absolutely. One simple technique is to divide your goals into 3 time-based buckets. The first is the conservative bucket, which focuses on your short-term goals during the first 5 years. Since we will be using these funds in the short term, we tend to use asset classes with less volatility, like cash, money market, CDs, and even short-term bond funds. Next is the moderate bucket, which focuses on years 6 to 10, and since in this time frame we can absorb a little bit more volatility, we tend to use a more balanced asset allocation. And then finally the growth bucket, which targets objectives years 10 and beyond. Since we're not going to be using these funds for many years to come, we invest for growth, accept more volatility, but have the opportunity for a much greater rate of return. Establishing a time-based financial plan is essential to help eliminating, if not deterring, those doubts and fears associated with investing. And it can ultimately lead to a better rate of return than that of the average investor over time.
Well said, Jeff. So if we're going to sum it up, allocate your assets based on the time objectives of your goals, stay disciplined, and don't try and time the market.